Hi everyone, this is Thomas from Curvo. Your savings account is costing you money. In this video, we're going to look at why you should passively invest your savings. So let's go. For the past few years, the interest rate set by the European Central Bank has been close to 0%. So banks use this number to determine the interest rate on your savings account. My account with BNP Paribas Fortis is at 0.11%. I suggest you actually check the interest rate of your own savings account. All right, it's maybe not much, but you're still earning a bit of money each year, right? Actually, on the contrary, you're losing money, or rather, you're losing purchasing power because of this thing that we call inflation. So inflation causes prices to go up every year. The central bank attempts to keep the inflation rate at around 2%. They don't always succeed, and at times it's way higher. Other years it's a bit lower. But on average, you can expect the price of pretty much everything you buy today to be 2% higher than last year. Looking at it another way, your current savings are worth about 2% less last year because of inflation. And because inflation has been higher than the interest rate, you've been losing money by keeping your savings on a savings account. So that's why passive investing is here to beat inflation. But what can I do, I hear you say? I know I could invest my savings, but I know nothing about the financial markets. I don't know anything about the stocks, nor do I have the time or the interest to follow my investments every day and sell before I lose all my money. The answer has actually been around since the 80s, but until recently it's been largely left underappreciated. It's called passive investing. It's based on the simple observation that rather than handpicking stocks and trying to buy and sell at the right time, it's usually more profitable to invest in the stock market as a whole. Just think about it for a second. When you're picking stocks, you're looking at pretty much for the best bargains, and you're choosing companies that are very cheap now, but that you predict will go up in value in the future. However, remember that when you're doing that, you're competing with all of the other investors in the world who are looking for the same bargains. Not just people like you and me, but mostly top analysts at big firms and banks who are paid massive salaries to spend the entire day with 4 screens researching and analyzing quarterly reports, all while keeping an eye on the television screen that's showing most likely CNBC for the latest news on the markets. So how can you possibly compete with them? By the time that your uncle tells you over Sunday lunch about that great stock tip that he heard about, these people have actually spotted the opportunity already, bought thousands of shares for their firm, and caused already the stock's price to increase drastically. So what you end up is actually missing out on that super hot bargain. So how does passive investing work? It's simple. You invest in index funds. An index is like a big bag of stocks where the rules are super clear on which stocks are included and how much you get of each company. The most famous index is the S&P 500, which has the 500 biggest American companies weighted by market capitalization. The MSCI World Index is another common one. It consists of over 1,600 companies across developed markets. We're talking about the US, Europe, Australia, Japan. And that's all super interesting, Thomas, but how does the return of an index compare to a savings account? Let's look at the historical performance of the MSCI World Index since 1979. As you can see, the performance, this is sourced from Backtest, the performance is fantastic. A €10,000 investment in 1979 would have resulted in 960,000 euros today. That number summarizes this entire chart as the annual return average is 11.1%. As you probably notice, this number is significantly higher than the return that you're earning from a savings account. So let's compare now the passive investing versus a savings account. The difference is really put into perspective when you focus at the returns over several decades. Imagine we have Lucas and Emma, 2 people who are both about to retire at 65 years old. They started working at the same age, let's say 40 years ago when they were 25. For all these years, they've consistently been saving 100 euros every month. There's one difference though. Lucas didn't know anything about investing, so he put all of his hard-earned savings into a savings account with a steady annual return of 1%. On the other hand, Emma was fortunate enough to have learned passive investing when she was a student. Because of that knowledge, she'd been putting her monthly savings into an index fund tracking the MSCI World Index. As you can predict, Emma's nest egg for retirement is going to be way bigger than Lucas. Let's just see by how much. So by age 65, both Lucas and Emma have put aside an amount of 48,000 euros. With his steady 1% returns on interest, Lucas has grown this to 58,989. That's the blue line. In the meantime, Emma's has grown to a staggering 335,000. That's the red line. That's over 5 times more than what Lucas has, and none of this required time nor financial expertise from Emma. All she had to do was deposit her savings into an index fund rather than the savings account at her bank. This chart is simply all you need to understand why you should passively invest your savings instead of keeping it all on a savings account. And I have to mention why Curvo is the best way to passively invest. There is a learning curve if you actually want to manage your own investments through index funds. You have to choose the right mix of indexes tailored to your own objectives, but also your appetite for risk. And you need to understand how taxes work. You have to choose a broker. In investing, mistakes can be costly, so these are topics which are important to master. We do understand, though, that not everyone has the interest, the time, or the motivation to actually teach themselves all of these things. So at Curvo, what we do, we take care of all of these complexities for you, and we build the easiest way to passively invest your savings. Do check out our website. I've linked it in the show notes. Thanks for watching. Hit that subscribe button if you want to see more videos like this to help the Belgian investor.